Welcome to the QOZ Fund III webinar today. Appreciate you attending. I'm Michael Episcope, co-CEO of Origin Investments, and I'm joined by Kyle Verhasselt today. He's our Vice President of Acquisitions, lives down in Nashville. Welcome, Kyle.
Welcome, Michael. Excited to join you today.
Yeah, excited to have you as always. Kyle covers Nashville and Florida. He lives down in Nashville. And I do have to say, we did not coordinate this outfit today. It was just, we got on and realized we were both wearing the same Origin swag this afternoon. So maybe we just have both have good taste. Kyle is our boots on the ground. He's responsible for finding many of our past QOZ deals and a lot of the deals that we do at Origin as well. And will no doubt unearth some great opportunities for Fund III investors as well. Today, I'm going to cover the fund overview, the macro environment, and then I'm going to hand it over to Kyle to talk about our pipeline and some of the deals we're evaluating for this fund. He'll hand it back to me to go over the terms of the fund, and then we are going to open it up for everybody's favorite part, the Q&A. Should be, I would say, about an hour, the entire webinar. We'll go over, if need be, for another kind of 10, 15 minutes, depending on the questions we get today. And I do want to thank you for your questions in advance. They help shape the webinar. Most of them will be answered during the presentation. So if you did email one of those in, you will most likely hear your question answered at some point today. Now, if you do have additional questions during the webinar, please put them in the Q&A here, and we'll get to those at the end. And that's it. Oh, the last thing I want to say before we jump into the webinar here is a big happy birthday to Jonathan Spitz in our investor relations department. Jonathan is celebrating a birthday today. Many of you know him as well, so I'm sure he would appreciate it if you just reached out to him and sent him a nice happy birthday note. So let's jump into the presentation, Jeff. Great. I'm going to start with the fund overview. We have both existing investors today and then prospective investors, people who are just becoming acquainted with investors, and thank you all. This is our third QOZ fund. Fund one was $265 million. Fund two topped out right around $315 million. And this fund will be somewhere between $300 and $400 million. It both depends, obviously, on how much we raise, but also the opportunities we find in the market, because QOZ has a very limited opportunity set. Now, I will say we've been in this market since late 2018, and our experience here, I think, is really important for a couple of reasons. But number one, investors in this fund, they benefit from that sourcing activity. There's really not a QOZ deal we don't see in our markets. And the second one is that a lot of that activity, we've been working on deals for the last kind of 6, 12, even 18 months, and those deals will wind up in this fund. The fund will be 100% invested in ground-up development in multifamily, and we invest in ground-up development to comply with QOZ laws. And these investments will all be located in qualified opportunity zone areas, so we can deliver the QOZ tax benefits to you. In order for you to get those tax benefits, you need to both invest capital gains that have been realized within 180 days. If you have any questions about that, you can go to our website. We've written a lot of blogs on that. I'm not going to go over the details today. They're different as an individual versus an LLC. And you need to be in the fund for at least 10 years to get the forgiveness of that as well. We give you the optionality to stay in the fund or get out after 10 years. You don't have to make that choice when you get in. You can make that choice in 10 years. And what I really like about this fund is it forces everyone, us as managers, you as an investor, to take a long-term view in investing. And when you're investing and you think about making an investment that's going to be 10, 20 years of your life, there's two really important questions to ask. One, am I in the right asset class? And two, am I with the right manager? This is an alternative asset class in a private investment. Well, I would say, to answer the first one, multifamily as an asset class, it's never lost money over any 10-year period. It's delivered some of the highest absolute and risk-adjusted returns to investors over the last 10, 20, 30, 40 years. It's actually beaten the performance of the S&P 500. It's outperformed office, it's outperformed retail, it's kept up with industrial on an absolute basis, and performed a lot better on a risk-adjusted basis than those other asset classes. So we only do multifamily at Origin. We're in this asset class for the reasons I just mentioned. We believe in its long-term growth and its ability to protect and grow capital, its tax efficiency, and to produce income for us as investors. Now, the second question about the manager, many of you know this. Origin was formed 16 years ago. We have a solid balance sheet. We have infrastructure. We have 60 team members. We are a profitable company, and we're going to be investing alongside of you in this fund. We're built for the long run, and we'll be here till the end of this program. The other things about the fund, it is expected to generate a 10 to 12% net IRR over the first 10 years, and around a 2.25 to 2.5 multiple on invested equity. And what the multiple means is that really what you should be looking at is how much money does this get. So if you invest $500,000 and we generate a 2.5 multiple, that can be equated to a $1.25 million worth of the investment at the end of year 10, right? Cash flow is included in that. It'll be a part of that investment. But we always talk about things in terms of multiple, and you should think about that as well, because IRR can be a little misleading, especially when you're looking out over 10 years. Keep in mind that this return that I'm talking about here and that we have in front of you, this is both a pre-tax and a post-tax return. We haven't factored in any of the tax benefits in that, but the gains on this will not be taxed when you exit the fund. In order for you to generate these same post-tax returns with a non-QOZ investment, if you were to put, $500,000 into a market rate fund and pay taxes when you invest, you would have to achieve well over a 3x return over that same time period. So this is really like, you have to look at this on a post-tax basis. We don't. When we're underwriting, when we're looking at deals, we look at QOZ deals in the exact same way we would look at any other deals. But the advantage of this program is the post-tax benefits. Let's jump to the next slide. So this is a slide that shows where we invest, and it's the markets we focus on are shaded in blue. And the general thesis for selecting a market is that we're going to be focusing on low tax, business and climate friendly cities in the Southeast, Southwest, and Texas markets. And we do this because investment performance is highly correlated to population, job growth, affordability. And these markets that you see in front of you shaded in blue, these are the markets that have been stealing population from northern cities for more than 50 years. COVID accelerated that. And this is only happening more and more, even in this day. COVID was like, I would say, inning 1 and 2. Don't want to use a baseball analogy, but we believe that this trend is going to continue because this is where businesses are going, where people want to live, and where we're seeing the highest growth. And it's important for you because you have to believe in these markets. This is a 10-year investment. And we, as a manager, we are going to create value during the business phase. Typically, when we're looking at an investment, we want to invest to a 30 to 35% margin. So if the costs of construction are $60 million, we want the building to be worth $80 million when we're done with construction, for example. Now, the development phase, it typically lasts right around 30 months, so about 2.5 years. But you might be in the asset for 10, 20 years. So 80, 90, 95% of your hold period is going to be in a stabilized asset. And so the important thing about that is that you want to make sure that you are in a city that has high growth potential, beta, that your rent growth is going to continue to increase year over year over year. And there's a huge difference in value creation between an asset whose revenue grows at 1% per year versus 4% a year. So when you're betting on cities like Sioux Falls, South Dakota, or Iowa, or where there's not really a lot of population growth or people going to those places, versus a city like Nashville or Austin or Dallas, those cities are going to win out every time. Our job as a manager is to pick the right deal and the right city. And our Origin has officers. You can see the blue dots. Those are offices. Origin has officers like Kyle who are in our markets, because you also have to know cities block by block and have the relationships, because real estate is a relationship game, and that's how you see deals first. Now, that's not where we stop. On top of that, we utilize machine learning, our own proprietary machine learning model called Origin Multilytics. And Multilytics helps us select and prioritize the cities that exhibit the highest forecasted rent growth over the next 1, 3, 5, even 10 years. So we aren't guessing on where we need to be. The model processes billions of pieces of data and ranks each of our cities. And more importantly, I think it gives us insight into the cities we should be avoiding. Combining the human element of boots on the ground, the Kyles of Nashville and others in their cities, with data scientists, it's a huge competitive advantage of Origin that really no other firm can claim. This is built for Origin by us. We employ data scientists to continue to work on this and iterate this. And ultimately, this is a benefit to our investors. Next slide, please. So this slide is our timeline of cash flows. And we get a lot of questions about this at every webinar, so I'm going to cover it here briefly. If you invest capital gains in this fund, your taxes will be deferred until tax year 2026 and then payable in 2027. Now, you should not expect any capital to be returned to you from us prior to paying your taxes. The timing doesn't work out in this fund because it takes around 40 months from the start of construction before a property can be refinanced. And once we get through the ground up development period in this fund, we will refinance assets. And that period is likely to start in late 2027 and last for a couple of years. And all of those refinancing proceeds will be sent back to you as investors. Your first opportunity to exit the fund will be around 2036. It coincides with 10 years after we let the last investor into the fund. There's a slight buffer there of a few months as well. But you can also opt to stay in until the end of the program, which happens in 2047. During the whole period, there's also going to be cash flow that's distributed to you. Here we're showing it as 4 to 6% per year, and that's relative to your initial investment. Could be more, it could be less. There are a lot of variables that influence these outcomes. One thing you can be sure of is at Origin, we will continue to communicate and update all of these forecasts in real time at each one of these webinars. So if we get better information, that'll go up. If we get worse information, those forecasts will go down. Last thing I'll just say, in my opinion, there's really no better investment option in real estate than a QOZ fund to generate long-term wealth. Real estate is already this very tax-efficient asset class, and what QOZ, it supercharges this already tax-efficient asset class and makes it that much better. But you have to be willing to stay in the investment for 10 plus years. All right, so the next part of my presentation is really the macro environment. And the macro, I'll cover about 4 or 5 slides here. You'll be familiar with a lot of this stuff, but it all impacts investing, whether you should be investing today, what the long run is. There are certainly headwinds and tailwinds, and I always talk about the macro themes in terms of whether it's a headwind or a tailwind, because at every point in time, one of them is winning. And certainly for the last couple of years, the headwinds have been destroying the tailwinds because of interest rates and cap rates and construction costs. But we're starting to see some things change in the market. And the chart you see in front of you is one of those positive changes. This chart is actually from today, this morning. I took it. This is a 10-year Treasury rate, and it's down nearly 70 basis points from its high of 5%, kind of middle to late October. That's an incredibly sharp move, and it's in the right direction. It's equally as sharp as the run-up. More importantly, it looks like inflation is getting under control. Fed is doing their job. They've been saying, they're saying, don't fight the Fed. Well, this is them doing their job right here, that right-hand side of the curve. The 10-year interest rate, it's really going to impact both financing costs and cap rates. So it's nice to see us finally getting some relief here, and we can hope for more. But I want to just say that when we're looking at interest rates, we're underwriting, not based on what we believe is going to happen in the future, but where they are today and what the Fed curve actually says. So we use data, not just opinions, when it's coming to underwriting and evaluating opportunities. Next slide. So this slide is one of the biggest tailwinds for multifamily. This is the cost to rent versus the cost to own. And right now, it costs around $2,800 per month to own the equivalent of an apartment that you can rent for $1,800. Now, you can see that spread, and you can look at the historical spread there, and generally, it's around $100. Today, it's 10x of that. It's $1,000, close to it. And it's never been more expensive to own a home relative to renting, which has been, this has been a huge demand driver for multifamily. Interest rates obviously hurt us on the capital market side, but they hurt single family homeowners just as much. And that demand, because people cannot afford to buy homes, we've seen a lot more demand for multifamily. Now, there's two main reasons for this gap, this spread. Number one, easy mortgage rates. Those could easily drop. And they've started to, as we've seen rates cool off a bit. But mortgage rates were up at 8% at one point in time. The other important point is housing prices, right? That's really creating that gap. And this one is stickier and not likely to change quickly. Now, housing prices have been driven up by higher construction costs, elevated demand as millennials reach peak buying age, and a general housing shortage. And none of that is going to be fixed anytime soon. We're not likely to see construction costs come down. The demand, the housing shortage, when you look at those things together, that is going to take years and years and years to fix. We're not even close to fixing that. So we do see a tailwind behind multifamily for quite some time. Next slide, please. So construction costs, I mentioned this briefly. This is a great gauge of inflation, and you can see from early 2020 to the middle of 2022, construction prices, they rose 40%. And they've leveled off. And we're not necessarily seeing materially lower costs like on the interest rate slide. And we don't expect that either. What we are seeing, though, are stable costs and more competitive pricing in the market. So we're not seeing that trend continue, which again feels really good when you're in this environment, when you can actually trust the pricing that you get, and it's better for more than 3 days. And now people are quoting it for more like a month or 2 months or 3 months. And you've had even the commodity prices settle down quite a bit. Now, the good thing, if there is a silver lining about higher construction costs, it's that they are a natural governor to supply. It's actually a barrier to entry because deals simply don't pencil out at these higher construction costs. And less supply today is the catalyst for higher rent growth in the future. So there is a silver lining to this. Next slide, please. So here is a supply slide, and some of you may have seen this on previous webinars. We continue to kind of add the bars as we get new information, and we've been talking about the existing starts in the market and how eventually this supply the near-term supply is going to be absorbed, and we're going to get to this environment where there's not a lot of newer supply, and we're starting to see that now. Now, certainly, we have near-term supply issues in many of the markets that we're in, but higher interest rates and higher construction costs are both doing their job. And you can see on the right-hand side, new inventory is falling off a cliff, or at least the expected new inventory. New inventory, as we sit here today, is hitting the market at a record pace. But I think, this is a great visual example of the Fed's rate raising campaign working. And new construction activity, it started to slow down significantly in the second half of 2022. There has not been a lot of construction done in 2023, and we're seeing that in the numbers. And we still have to get through this near term, and in most markets, it will take some time to absorb, but it's going to be faster than you think. And let's go to the next slide, and I'll talk about that. So what you see here is the year-to-date demand. These are the top 20 markets in terms of unit absorption. And these are the markets you'd expect. These are the Houstons, the Austins, the Dallas, the Nashvilles. This is where people who are allowed to work remotely, these are the cities that they are choosing to go to. The ones outlined in blue are the cities where we invest. So predominantly, we have a lot of cities in the top 20 here. The supply will get absorbed, and there's not much behind it. What our models are showing is slow to negative rent growth over the next 12 months in almost every one of these markets. There's no market that is spared from this supply. And then after that, there's an upward trend in rents and also an upward trend in occupancy. As a long-term investor, we have to look past these short-term disruptions, and we firmly believe that these are the markets you want to be in over the next 10 plus years, and it's obviously where we want to be and where we're planting our flag as well for the next 10, 15, even 20 years. I'll leave you with this before I hand it off to Kyle. The reason I believe this is a great time to invest in real estate in this fund is because every variable has moved to an extreme and risk has reared its head. Borrowing costs have gone from 3% to 6.5%. Cap rates have gone from 3.5% to more than 5%. Construction costs are up by 40%. Every variable has gone against us over the last few years. And today, it feels like the worst is priced in, and there's far more upside than downside where we're sitting today. Only the best deals, and you can think about this, how when you're looking at deals out there, it used to be that 1 out of 5 deals would make it through the filter. Then it was 1 out of 10, and today it's more like 1 out of 20. So vintage matters when you invest. And I think in a world like this, when we're underwriting to these extreme variables as compared to where they've been for the last 3, 5, 7, 8, 10 years, there is asymmetric upside to this investment. So Kyle, I'm going to hand this over to you, and then I will see you at the summary of terms.
All right. Thanks, Michael. Our QOZ pipeline, so as Michael alluded to earlier in the webinar, Fund 1 and Fund 2, we put out just around $600 million in equity. That equates to just over 17 projects and 5,000 total units. As we look today for a QOZ Fund 3 pipeline, we have a pipeline currently of 1,600 units, just under $500 million of total asset costs, and just under $200 million of total Origin equity to be needed. If you were on some of the last 2 webinars for this fund, you may notice some assets are still on here and some assets have been removed. This is constantly being updated as myself and the respective deal officers are constantly asking our development partners questions about opportunities. And as we gain information, whether it be positive or negative, we make the determination if the deal is feasible to move forward. When we look at this current pipeline of opportunities, there's really 3 common themes that exist today that get us excited about deals. One is economic incentives. For those that have been on Origin webinars or read our Origin Insights, that can be in form of programs like in Texas, PFCs. You may have heard Florida has Live Local Act. Programs are being in place, but really the opportunities we'll touch on here shortly come from local municipalities offering some form of economic incentive. And what that means is we'll exchange some component of affordable units in lieu of some tax abatement or similar type of structure. The other thing on this list that really jumps out for opportunities for us are BFR. Michael alluded to the cost to own to rent. You also have, when you look at housing stock, many of the folks that would be in the buying age today are first-time home buyers. They're used to a certain level of finishes, amenities, and most importantly, they're used to living in a location that has the amenities right out their front door. So that could be their place of employment, that could be retail, recreational amenities right out their front door. And that's something that the BFR projects that we chase and pursue have in common overall. They also get the added benefit of having a pool, clubhouse, gym, et cetera in there. Whereas if folks would look to have a house with those, that would only further exacerbate that cost of rent to own. In this respective pipeline, you can see there's a deal in West Suburban Phoenix. That's a build for rent project. We're also pursuing a deal in Daytona, a BFR project with a well-known national developer. Both those opportunities are still in the preliminary stages, but they check the box in terms of across the street, you have national retail, you have to be announced national retail, grocers, et cetera, coming in that only further in a 10-year hold period gets you excited about the continued demand for the product. And the last thing is the overall theme for our pipeline and opportunities. And this is no different for QOZ or non-QOZs for us. We look for high barrier to entry stories. So that can come in the form of it's hard to get zoning done for that respective project. Municipalities today, with the cost of infrastructure, whether that be utilities, stormwater, et cetera, it's becoming more and more challenging, which further creates an opportunity to further outperform if you can get a deal zoned and completed in today's environment. Within the high barriers to entry, you'll notice the keyword to a lot of all the opportunities actually besides the build for rent, and that is infill. We look for opportunities, whether that be in infill in downtown locations or in a suburban location that's infill that has a town center type feel, live, work, play. Think about being able to access the same amenity base and be able to jump on a common interstate or major thoroughfare to get everywhere you need to go. Next, we'll jump into an opportunity. Next slide, please. So this is an Atlanta infill opportunity. We touched on it briefly last slide. We're still in pursuit of this opportunity. One of the largest things and overall theme from the pipeline page that we like about it is this project's in discussions with the city of Atlanta for an economic incentive. It'll come via, as we touched on earlier, some form of tax abatement throughout the QOZ hold and potentially longer in lieu of X% of the units. The other alternative being in discuss with the city is there could be some form of affordable units, but instead of a tax abatement, could come in the form of a very favorable government financing structure. So that's as much as we can disclose on that. But why we like the opportunity on top of this, it's in an infill location. If you can see the bottom picture, the Mercedes-Benz Stadium probably is recognizable for a lot of folks just in terms of where that is in Atlanta. But this is a submarket that's rapidly gentrifying. It has already occurred. A lot of top movies, films are filmed in this area because of its character. You have a lot of old warehouses, industrial buildings that have turned over into retail shops, restaurants. And as a result of that, you have newer multifamily being seeked out there as folks want to live here because of its proximity to amenities in the area, employment nodes, and just overall ability to get around the city. We also, what we like about this project, it's with a developer we've done 2 other deals with. And so again, getting back to Michael's point of existing relationships, being able to get the opportunity to have first cracks at deal, given that working relationship, has allowed us to be in that front conversation with the group it also allows us to provide our thoughts and feedbacks on how we think we can make the project more accretive overall, given our expansive portfolio of assets and intel that we receive on the ground. This is a project we'll continue to keep folks updated as we move forward and getting more information on the economic incentives from the city, and hopefully be able to provide a better update as the next webinar comes around. Next slide, please. Next deal here is a QOZ deal in Asheville, North Carolina. Asheville is a great city that is proximate to a lot of high growth Southeast cities. You're 2 hours away from Charlotte. You're 3.5 to 4 hours from Atlanta, depending where you are. And where I currently sit in Nashville, you're only a 5-hour drive. Asheville is a great city, as well as it's kind of nestled in the Blue Ridge Mountains. So you have that great feel. What we like about this deal is you have a heart of a city location with walkable retail core amenities. So for folks familiar with Asheville, this is in the Biltmore Village. Biltmore is close to the Biltmore Estates, the Vanderbilt family's estate that many folks around the country will make a visit to see the history in the area. But this project overall, high barriers to entry, as you could imagine, given that history. Within that, there's an economic incentive under negotiation, so cannot share much of the details on that. But similar to the idea in terms that we discussed on the infill Atlanta deal, will be similar in this opportunity as well. We also like building the right product in the right submarket. Just because you can build a deal doesn't always necessarily mean you're building the right deal in the respective submarket. Here, we're building a surface park deal, garden deal, plus it has a mix of blend of built for rent and townhome units within the community. So it creates a great cohesive community. It's able to give a wide range of unit types and product type to prospective renters. And they have the added benefit of being able to walk to the 40 to 50 shops surrounding the Biltmore Village. So we're super excited about that in conversations. We're also, it's of note that this is with a project we have done existing deals with, which is a common theme, tying back to relationships and being able to be involved in those conversations early on versus out-of-state groups that may not be as familiar with what's going on in these respective markets. So again, kind of tying to the overall theme, great economic incentives, high barriers to entry market, and then it has a tie of the build for rent townhome product that we like to achieve in this current marketplace where we see demographics. Next slide. This is a slide, an opportunity mentioned earlier that there's some new opportunities and there's some opportunities that have been removed from the pipeline. This is in infill Tampa. It's close to the Water Street master developments that have been ongoing. That, if you're familiar with Tampa, has changed rapidly in the last 3 years in the continued development. This respective submarket obviously is an OZ. What we really liked and got us excited about this opportunity was it's part of a greater master plan development where the actual master plan developer is developing this project. It was one of the last wood frame construction deals, although it's structured parking with a concrete deck and one level of podium with 5 level of sticks above it. All the remaining parcels will be concrete and steel construction, which would mean your cost basis is going to be up to the tune of 20-25%. And respectively, you're going to need that much higher rents. The other component with the catalytic drivers is this area is also attracting a lot of corporate expansion or relocations. So think of groups that have multiple offices in and around the Tampa MSA. We're looking at making a large headquarters in the area, and attracting both local as well as relocation headquarters, and the combination of a lot of great walkable retail. However, as much as we loved all those catalytic demand drivers, just given where the cost of the concrete for the structured parking and one level of podium and the respective rents we would need for the project. We also, Tampa's a market that is being able to start charging for parking is more of a norm, but it's certainly newer to the market. And for this respective opportunity, you would need to assume every unit was able to charge a pretty decent price to it. And we looked at it from an overall bell curve of distribution for risk versus reward. And it did not seem like there was much upside as we like to see in our traditional opportunities relative to the total deal. So when you factor those in with the total deal size for the respective fund, it was an opportunity. We had to let the developer know we were a pass, but nonetheless, a great opportunity to be in conversations and get market feedback on what's occurring. So with that, I think I will pass it back to Michael.
Alrighty, thanks, Kyle. Summary of terms. I'll go over this and then we'll go over some questions. So please, if you have questions, put them in now and we'll get to those in a minute. The fund, everyone pays a 1.25% asset management fee, and that is based on NAV, so net asset value. The idea is that this fund will grow over time, and we equate that through a unit price. Minimum investment is $50,000. If you invest 50, but then have add-on investments in the future, we do take lesser amounts. There's an acquisition fee that we take on each and every project that's charged to the fund, and that's 0.5% of the total project cost. And so if a project costs $60 million and it's 0.5% as an acquisition fee, that's $300,000 on that particular deal. There is a performance fee as well. So I always tell people that subject to a 50-50 catch-up after a 7. The general theme is that we get 15% of the profits so long as we do our job. If we only make a 6% net IRR to you, we get 0. If we make a 7 and then the math gets funky as we get 8 and the catch up and all that. But if we generate a 10 to 12 net, then we've made 15% of all profits. And there's a setup fee as well based on how much you are investing in the fund, and that can range from 2% all the way down to 0%. And this is an audited fund. We have in-house counsel, but we also use Better Price on these funds as well. And there's not really any liquidity in this fund. We do make exceptions if people have situations that are unique, but this fund is not designed to allow people in and out. And you as an investor really need to think about being in this fund for 10 plus years. If you want to get out, and we do have the cash and we allow that to happen, there is a steep penalty for doing so as well. Okay, so let's go into the questions now. And Kyle, do you have our first question teed up? And please, everybody, put your questions in the Q&A and not the chat box. We will only be working from the Q&A. Thank you.
Yeah, first question, seeing here that was submitted earlier, just talking about what we're seeing for interest rates on the construction side. There's no doubt that bank debt, LifeCo debt, construction debt has dried up. However, we're still seeing bank debt quotes. We have 3 deals that we actually received term sheets in the last 4 weeks. Those are at 55% and at price from anywhere from 300 to 350 over SOFR. So SOFR is at 530 today. What we're seeing, talking with groups, intermediaries, brokers as well, that banks and LifeCos, it's a flight to quality across the board. And so they're really focusing on top tier developers and sponsors. And we're fortunate enough with the amount of business we've done in relationships that we've had the last 3 years in the development space that we're part of that group and being able to attract those term sheets yet. If you look at from non-bank debt, there's debt funds available at 60, 65%, but your cost of debt goes up significantly to, instead of 3 to 350, you're 475 to 550, which in many instances, when you add in SOFR, your interest rate's greater than your unlevered return in those deals. So that's not something we're interested in pursuing.
Unless we're lending, let's
Yeah,
just be
yeah. I'm not from the lending, but we're on the
unless we're the
equities.
lender in those deals. But you're right, we wouldn't do that. Deals generally can't pencil out. So John asked the question: why are the cash flow estimates by year in the outer years of 4 to 6% higher than the recent projections for Fund One and Two in the last webinar? John, vintage matters. And when we think about Fund One, we were underwriting to a 5.3, 5.4% return on cost in those funds. And we had a tremendous amount of headwinds. Your rise in construction costs, your rise in interest rates, your rise in cap rates. So we've seen a lot of that margin disappear. And the formula, when you're trying to forecast what you're going to be able to achieve in cash flow, takes all of that into account. Your rent growth, your margin, your spread, where you're going to be financing debt. And so in this fund today, and this is what I was alluding to earlier, why I think it's going to be a good vintage. Our new bogey for this market, right? We're still trying to achieve that 30 to 35% margin. But when your cap rates are starting at 5% and you're drifting those to 5.5 over the first 5 years, you're looking at a return on cost of 6, 6.25, even 6.5 in those cases, right? And that's the cap rate that you're developing to in the future. What I don't want to focus, right? Like I always say this on every webinar, right? We do our best to provide investors with guidance on what we believe we can do, and we will continually update these webinars. In Fund One and Fund Two, it could be that it goes up as we get more good news from interest rates and cap rates and things like that. And certainly a lot of those deals are going into leasing and we're getting new information. Our job is to give you the information as we get it. And I hope that I was able to answer your question satisfactorily, the reasons why a fund like this might produce 4 to 6% in the future, and why Funds One and even Fund Two. And we brought those down considerably. And thank you for your investment. But if we're, originally we were at 6 to 8%. And then as rates went up and they kept going up and kept going up, we moved that down to 5 to 7, then 4 to 6, and then even lower than that because of the headwinds in that market.
Next question. Have there been any trades to stabilize assets in your markets lately? What were the cap rates? The short answer, trades are down 70 to 80% year over year in all of our respective markets. The trades that we are seeing transact are deals where either they have debt maturing and they can't get extensions, or there's family office money. So we're seeing as low as on the family office 1031 side, 4.5. Wouldn't say that's where the market is. And then we're also seeing on opportunities where folks have to sell on debt 5.25 as well. So it's hard to pinpoint exactly where cap rates are on stabilized asset, just because you look at the chart Michael shared earlier with the 10-year treasury, we're down 70 basis points in the last 45 days. And so huge volatility right now. But the fund and the capital structure of each individual deal is set up to ride the roller coaster and withstand it, versus being caught in a situation where you have to do something that you don't want to do.
Yeah, I'll add to that, Kyle. We have these conversations. Great question. We have these conversations internally all the time. And I remember credit committee in the middle of October, and every single comp sale that you can bring to credit committee at that time was irrelevant. It didn't matter because it was such a different environment, because we had a 90 basis point run up in the 10-year treasury. And when you think about when a sale happens and everything that goes into that sale, it was a completely different environment even 3 months earlier. And you had to discount those and use a little bit of an art to say, look, if those were trading at 4.75 to 5, where would we be today if they held at 5? And so, we had this massive run up, but we as risk managers always take that into account. And I agree with Kyle, like the market is somewhere for class A. You have to understand that there is class B, C, D. Some of these things, like you can buy distress out there in properties that we certainly don't want to own at what looks like I would call a high cap rate. but it could be actually a value trap where you're getting an 8% cap rate that turns out to be a 3 after you're all said and done in those deals. We only operate in the Class A space. And right now, I think you're 5.25 based on where the interest rates have been for the last couple months. The anonymous asked the question, is the 15 to 30% return of investment after refinancing taxable? The answer is no. So all of the tax advantages of real estate that you would get in a normal non-QOZ investment also translate to QOZ investments. And one of the things in real estate in general, this isn't a QOZ thing, refinancing is always tax-free. You can refinance over and over and over. And that's why when you hold a piece of real estate for 20, 30, 40 years and you built it at 20 million and now it's worth 200 million, you've never paid taxes if all you're doing is refinancing and taking money out through that. It's also why people do a lot of 1031 exchanges, because your basis becomes negative. Now, what you also get is the benefit of depreciation here, which is huge. So anything we're looking at in terms of the cash flow, that 4 to 6%, should be 100% offset by depreciation. And then at the end, typically in real estate deals, when you sell, you get something called recapture. You don't get that in a QOZ deal. So it has amazing tax benefits throughout and at the end.
Question from Rob on the chat. Are you seeing distressed land sales? Do you expect to? The short answer is we have not seen distressed land sales in the OZ space. I think this is still too early to tell. However, what we have seen is we have seen land contracts that people have gone under contract, more of land options with limited deposit, hard money deposits up front, where they'll create the optionality for the next 9 to 12 months before really having money at risk. And the thought for many folks and developers, and we've had the conversation, is they're looking at having an option into a better environment, fundamentals, interest rates going. But do you expect to? Undoubtedly, yes, we expect to see some opportunities with folks that may have put on land loans that come in and can't get deals moving forward. So it's something we're always in conversations with, and we'll keep the group updated.
Rob asked a question, anticipated current cash yield from year 4. How much of the 10 to 12% net IRR do you expect from current cash yield versus property price appreciation? Rob, I would, again, I said this in the beginning, IRR is a it's a time-based metric. So I would look at this more in terms of multiple. Going back to the example I gave, if you invest $500,000 and we generate, over that time period, a 2.5x multiple, you're looking at $1.25 million. And you can look at it. So if you're in that deal for 6 years and you've made 30% on that $500,000, the math is pretty simple. So you're going to be, what is that, 30%, about $150,000, maybe $200,000 in cash flow, and the remaining is going to be in appreciation. But you should also consider sort of the 15 to 30% that you're going to take out in refinancing as well, which is considered a return of capital and non-taxable.
All right. Question on the chat. Will there be any option to borrow on investments during the 10-year period, from Lawrence? Lawrence, in regards to if you're looking at Origin from Strategic Credit Fund, we will not borrow from one fund debt to the other fund.
Kyle, the way I read that is, well, there's 2 ways. Are we going to be borrowing at the asset? The answer is yes. Lawrence, can you borrow against your investment here? Likely not. I know that investors have asked in the past if they can leverage up their investment and borrow against it like a security. No, but certainly our job as a manager is to optimize the capital structure of each and every investment. So typically we use 2-to-1 debt to equity. We don't use more than that, except a little bit more in our growth funds, because those have more of an opportunistic profile. But this fund we will be running at kind of that 65%. So when we're done with the development phase, if we find ourselves where we've created a tremendous amount of value and we're now 40% loan to value, we will go out and borrow against that. And hopefully we answered your question. Go ahead, Kyle. You want to take another one?
Yeah, Rob, who or what type of institutions do you prefer to borrow from? Our typical borrow is a regional bank. We evaluate their balance sheet, look for their deposits, make sure they have a healthy ratio as a going concern forward, especially in light of everything in March, April timeframe with Silicon Valley Bank. We do a deep analysis and talking with them. So our typical lender is a regional bank or national bank. We'll have discussions with life insurance companies as well for our construction loans.
So a couple of questions here I'm going to knock out. Can you talk about the performance? Again, I might have missed it. If you want, I went over this in detail. I'll give it quickly. 10 to 12% net IRR over 10 years and anywhere between a 2.25 and 2.5 net multiple. That's our forecast sitting here today. I always want to caveat forecast. The further you go out in time, the more variance you have around a forecast. And in a fund like this, when you're trying to predict something, this is only to kind of, give investors a general idea of where we will be in time. What we do, I think, a really good job at is communicating at every point along the continuum. And I don't want to discount the amount of work that goes into these forecasting. There is a lot, and we take into every variable. But the further you go out in time, just the more volatility there is in that forecast.
Michael, you touched on this on one of the last slide on fees, but when will Fund III close and when will the deals in the fund be finalized?
Yeah, you want to answer that or you want me to?
Yeah, the fund will be open until the end of 2024 or the earlier $400 million raise, as Michael touched on earlier.
Yeah, I will caveat it though. We had a period in Fund One, like it's always dependent on the market opportunities that we can find. And if we can't find market opportunities that fit our criteria, we will close the fund earlier. We will stop accepting capital. So we did this in Fund One. We weren't as sure. We had money coming in a lot faster and for about a 6-month period, we said, hey, let's make sure that we can actually invest this in deals we really, really like. And then when our team, Kyle being one of them, went out there and sourced a lot of deals, we opened the fund back up. So we have a target of $400 million, but it's always predicated on making sure that we can put money out in a judicious way.
Rob, are all your loans property-specific collateral or cross-collateralized across the portfolio? They're all property-specific collateral. We never cross-collateralize assets in any of our funds or deals.
Yeah, that's a quick, simple answer. John asked, are you considering any incentive on fees for current investors? John, the only fee that we can really think about as an incentive fee is the admin fee. And we try to, loyal investors, of course, we will have that conversation with you and others and look at your sort of aggregate investments across our various funds. So if you're in Fund One and Fund Two, have a conversation with whoever your investor relations contact is. You can also reach out to me, Michael at Origin Investments, and we'll have that conversation. But we absolutely believe in rewarding loyalty. Kyle, we got 3 left.
Looks like if you want to touch on the raise to date and the NAV and the K1 kind of all coincide.
Yeah, John, good question. If I have to guess, like offhand, I haven't looked at the fundraising on that side. I can get you an answer in a second for sure. I want to say we're at around $40 million in Fund 3. It hasn't been open that long, but the fundraising, I think, even in this environment, has been pretty good relative to what we've seen in sort of our other funds, especially for ground up development. And I sort of alluded to this earlier, that what I love about this fund is you have to have a 10 to 20 year outlook, right? And so if you have a 2 or 3 year outlook, you may not want to invest in ground up development or multifamily or even real estate today because of all the headwinds. I wouldn't blame you. But when you're looking at something 10 to 20 years, we're going to be in multiple periods where we have through recessions and headwinds and all kinds of interest rate shocks and global shocks and things like that. And so, if I'm going to be in that, I love multifamily as the asset class itself. Does the fund, Denzel, sorry, I've got 53-year-old eyes here and I can't always see. Hopefully I pronounced your name correctly. Does the fund issue one consolidated K1 or multiple one per state? Consolidated, and that's something that you can opt into. So we try to make it as easy as we possibly can for investors. And the reason is because we're investors. I hate K1s. Everybody hates K1s. They're, unfortunately the nature of this business. So we try to, as many as we can, make it easy on you. The good news too is a lot of the states that we're in, they're zero tax states. So when you're talking about Tennessee and Florida and Texas, they don't really, the K1s there are pretty easy on those. When will you start floating the NAV? Anonymous asked, that's after the close, way after. So this fund will likely be closed at the end of 2024. And then what we do is we true everybody up on their preferred return as well. Certainly, if you're in the fund earlier, you're earning that preferred return. And if you get in the fund later, you have to pay people who were in earlier that preferred return. That is not something that goes to Origin. A true up is common across every single fund out there. And that's how it works. So once we equalize everybody, then we would float the NAV. Rob asks, how much is the GP capital commitment? Rob, there's no magic number to that GP capital commitment because number one, David and I have to have capital gains to be able to invest. So in any of our funds, if you go back at Fund 1, 2, I don't believe there was, this is how much we're putting into this fund. It's going to be based on how much we have in capital gains, what our other exposure is. I can tell you that I'll be investing in here. I'm 99% sure my partner will be investing in here. We've had some liquidity events from last year. So we will be investing alongside of investors. I just don't have a target amount and we won't for those limitations. It's a little bit different than a market rate fund where you're using after-tax capital. John, we appreciate the question. So John said, thanks for answering my questions. Of course, that's what we're here to do. Kyle, anything else to add?
No, I think that we covered it all, but we're still seeing a lot of great opportunities and we're excited about this fund and the prospects for it.
Great. And thank you everybody for hanging in here until the end. It looks like we have 74 live participants still. I know a lot of people are going to be watching the recording on this. Thank you for your questions, for your interest in partnering with Origin. And if you are a current investor, we're privileged, honestly, to have you as an investor. We really enjoy this. We think this is a great fund, a great opportunity, and the right time to be investing in real estate as well. If you have any more questions, you can go to our website, origininvestments.com. You can download the materials right there on our website. You can email investorrelations@origininvestments.com. You can email me, Michael, at origininvestments.com, or email your investor relations contact. So we have a lot of ways for you to get in touch with us, okay? Or come to our headquarters or any of our satellite offices and just knock on the door and you can talk to one of us directly. So thank you very much. Really appreciate your time today.